The Fed didn't cut rates, and the dot plot turned hawkish. Here's why we're not losing sleep. Markets panicked when Powell mentioned a meaningful amount of inflation. But at DKI, we focus on real signals, not the noise. The Fed's track record on projections? Let's just say it's not great. Long-term rates are set by the bond market, not Jerome Powell. The Fed's toolbox is looking pretty empty right now. Watch the full video, because when the market reacts to shadows, we follow the fundamentals.
Gary, thing number one, it's all about the Fed meeting.
All right, Rob, let's go through the news before we get to the conclusion. So the Fed meets every month for 2 days. And at the end of their 2-day meeting, they come out and, it's like Groundhog Day, and we see if Jerome Powell sees a shadow. But what they do is at 2 p.m. on Wednesday, they issue a press release that explains what the Federal Reserve has done or not done. And then at 2:30, Jerome Powell, the chairman of the Fed, meets with the press and has a televised press conference. So last Wednesday, the Federal Reserve came out and kept the Fed funds rate unchanged. This surprised exactly nobody, but there was news here. June is one of the 4 meetings a year where the Fed provides a dot plot. So for people who don't follow this constantly, the dot plot is where 4 times a year, each governor of the Federal Reserve puts a dot where they think the Fed funds rate will be at the end of this year, next year, and the following year. They give the projections for inflation, for GDP. It's a sense of where the organization is on an individual level. Now, nobody signs it, but each governor does get a dot. So even though the median expectation for this year remained at 2 25 basis point rate cuts, fancy way of saying half a percentage point, the details were much more hawkish. The number of Fed governors who now expect no rate cuts almost doubled from 4 in March to 7 now. So many more Fed governors are saying, we don't think we're going to cut at all. In addition to that, Chairman Powell dropped this particular bomb during his press conference. Ready for this one, Rob? The chairman said, we expect a meaningful amount of inflation in coming months. That was not what the market wanted to hear. You could see in real time the market dropping when he said it. Sure, that comment was temporary and tariff related, but it wasn't what the market wanted to see. But, like I told you before, at DKI, we are completely unconcerned by any or all of this.
Yeah, so Gary, you say that and unconcerned about this report, dot plot, what that looks like means. Why is that? Can you explain for the viewers why there's just this lack of concern from your side?
Well, first of all, these kinds of things, changes in the Fed funds rate do move the market. But, one thing we're going to talk about later in this episode with Cash and Crow, our intern from the University of Tennessee, is that our portfolio is heavily hedged. When I wake up in the morning, I'm focused on the news for our positions and our stocks, not where the market's going to be. The next thing is the Fed has a horrible track record at predicting its own year-end Fed's fund rate. We actually tracked this, and one of Cashin's predecessors, Andrew Brown, also from the University of Tennessee, did great graphs on this a year or so ago. And, typically with 6 months to go in the year, Fed projections are not worth a whole lot. So, what the Federal Reserve thinks today bears very little resemblance to what they're likely to do by the end of the year. Now, let's give Chairman Powell credit here. To his credit, in the press conference, he actually said out loud that the Fed has a lack of confidence in their projections. And so, what I can say on that is that I admire his honesty, and I agree with his conclusion that the Fed really doesn't know what's going to happen. And let's give him credit for saying that out loud in public. He's right, but not many people have the guts to say it. So good for him for admitting that. Finally, Rob, the market focuses a lot on the Federal Reserve, but there's really not a whole lot they can do at this point. If they were to, people are worried that if the Fed doesn't cut, we're going to have interest rates that are too high and it'll slow the economy. But if the Fed does cut rates, what will happen is the bond market will price in higher projected inflation, and it'll lead to higher long-term rates. And this leads to something we've talked about in prior versions of the 5 things, but it's really important. Many people incorrectly think that the Federal Reserve controls interest rates. They do not. They control the Fed funds rate. That is the overnight rate. Everything else from a week to 5 years to 10 years to 20 or 30 years is set by the bond market. And so if we go back to last September, October, November, during those 3 months, the Federal Reserve cut the Fed funds rate by 100 basis points, 1%, but the yield on the 10-year actually rose by 100 basis points. And the reason is the bond market was pricing in higher future inflation. So demand for treasuries will rise and fall with geopolitical conflict, but long-term inflation and treasury yields are going to rise with continued massive deficits from Washington, D.C. The only thing that can save us from higher rates is a reduction in congressional spending. That's not going to happen regardless of whether Team Red or Team Blue is in charge of the place. Both parties will always spend more no matter what. So I think the Fed they're painted into a corner. There's just not much they can do. But Rob, let me ask you, as the CEO of a small but rapidly growing business, how does this affect you? Do interest rates matter for you when you're running Flying V?
Yeah, good question, Gary. I mean, I think for us, we've been a small bootstrapped business since day one, right? So we haven't taken on investment, a lot of debt either, right? So obviously, yeah, we're keeping a pulse on just regular interest rates, the market, the Fed funds rate. We are growing though, and are looking to scale. So we're looking at, what our potential opportunities for capital. Line of credit is something we're exploring right now, right? So just either stability of cash flow, right, or for us to inject capital quicker than just organic growth that we're seeing through the business in certain areas. So I think that's an area where, yeah, when we're definitely making changes to how we finance the business or capital opportunities, looking at that. But I think from running the business, it's more so just been how has the interest rates affected the macro environment and our clientele, right? I think is where I see the biggest fluctuation. So, I think at the end of the day, media buying, marketing, and advertising, right, it's a big piece of the macro economics to where, when we do see the market contract, we see advertising dollars get cut, right, in certain areas. Obviously, there's correlation with rising interest rates and whatnot and how businesses are attacking the market. So, but I think, again, it also is mentality too, right? So obviously, hey, when blood in the streets, there's opportunity for growth, right? So I think it depends on the mentality of the businesses that we work with too, to where, hey, when everybody's contracting or pulling back or cutting spending, interest rates are high, that's when I think some of our best clients get more aggressive, right? Because they see opportunity in the market while everybody may be worried, unsure, uncertain, etc. So yeah, we keep a pulse on it. But again, I'd say for us, more effect on what it does for our clients, their spending habits, budgeting, right? And then more so just that in uncertainty. When there's uncertainty, it's harder for people to spend marketing dollars. When they're more certain about the economy, just general performance, less volatility, then obviously it makes it much easier for them to allocate those resources towards growth, towards new initiatives for bringing in new business to the organization. So, yeah, we keep a pulse on it. And right now, yeah, with line of credit, we're looking at some capital injection, definitely obviously keeping an eyes on what those rates are and what our buying power is on any given week. So,
Rob, one of the things you're doing that I think is really smart is looking for those lines of credit now before you need it. I had this conversation with somebody many years ago. She was looking at buying something and she said, I want to take on the least amount of debt possible. I said, why? She said, well, because I don't like debt. I don't want to have debt. And I said, no, you should get as much cash now as possible. She said, why? If I need cash later, I'll just go get a loan then. And I said, because that doesn't work, because when you need money, nobody will lend to you. She's like, well, that makes no sense. I'm like, well, from our point of view, it makes no sense. But from the point of view of the bank, right, lending to somebody who needs money, who doesn't have cash, that's a problem. So I think you're really smart in thinking about locking down a line of credit when you don't need it, because now is when you can get it. If you're in a situation where you desperately need it, the answer is either going to be no or maybe, but with really bad terms.
That's exactly right. Yeah, you got it, Gary. So yeah, definitely being proactive, putting yourself in a position, forward thinking. What type of moves do you want to be able to make, and having that flexibility? So yeah, I think that's great advice just for individuals as well.
And
Gary,
by the way, one other thing to think about, you were just talking a minute ago about how interest rates may affect your clients. And, you run a marketing firm. If business isn't good, you always have the ability to say to them, well, don't you think you should invest in growing it?
I would always say that, yeah, we play a little bit inverse of the market, right? At least that's my philosophy, right? Maybe a little bit sales forward, but yeah, it is true, right? It's like, okay, well, if you do have business contracting, it's not as easy to acquire new business, or you need new business growth as a catalyst. Marketing is a great option.